Here is Nuburu Inc., ticker symbol BURU, is currently trading live at $0.26 per share, experiencing an intraday drop of $0.0088, which translates to a 3.22% decline for today's session. And that single data point, $0.26, tells us almost everything we need to know. It's not just a price, it's a market verdict on a very complex story. The immediate expectation when you hear industrial blue laser technology is of advanced manufacturing, high growth potential, and perhaps a ground floor opportunity. The reality is a stock trading for literal pennies, deep in the high-risk territory of microcaps and fighting a daily battle for its very survival on a major exchange. This 3.22% move isn't the healthy ebb and flow you see in Apple stock or even the wild, volume-fueled swings of Tesla stock. For a sub-dollar stock, this kind of percentage move can happen on extremely low volume, driven by just a few thousand shares changing hands. It's noise, but it's dangerous noise. The expectation is that you're buying a piece of the future. The reality is that you're holding a speculative instrument where the bid-ask spread alone could cost you more than the commission. Let's establish the common ground, the narrative that gets investors interested in a name like Nuburu in the first place. The story is compelling. Nuburu's entire business is built around high-power blue lasers. The core thesis is that blue laser light has unique properties, particularly when it comes to processing certain metals that are reflective to traditional infrared lasers. We're talking about copper. A lot of copper. Why does copper matter? Because it's the critical conductive material in electric vehicle batteries, in power electronics, in data center infrastructure. The narrative is that as the world moves toward electrification, the need to weld and process copper efficiently and cleanly will explode. Nuburu presents its technology as the only viable solution for these specific advanced applications. It's a clean A to B to C story. More EVs means more batteries mean more copper welding, and more copper welding means more Nuburu blue lasers. This is the expectation. This is the story you might tell yourself when you open your SoFi Invest app and see a stock for 26 cents. You think, if this technology is what they say it is, and they capture even a tiny fraction of the EV market, that's the hope. Now let's challenge that. The market right now is telling us it does not believe that story, or at least it believes the risks so completely eclipse the potential that the company's entire public equity is worth less than a small private factory. The 26-cent price and the struggle to even hold that level is the reality. The single most significant reality check for Nuburu Inc. is its status on the Nasdaq. A 26-cent stock price is not compliant with the exchange's minimum bid price requirement, which is typically $1 per share. This means Nuburu is or has been under threat of delisting. This isn't a minor issue, it's an existential one. When a company falls out of compliance, it gets a warning and a period, often 180 days, to regain compliance, meaning its stock has to trade back above $1 for a consecutive number of days. How does a 26-cent stock get to $1? The options are grim. First, a sudden massive surge in positive news, a huge contract, a buyout offer, could send the stock soaring. This is what every holder dreams of. The second and far more common path is a reverse stock split. This is a purely cosmetic, often value-destroying maneuver where the company declares that, for example, every 20 shares you own will now be combined into one new share. Your 10,000 shares at 26 cents become 500 shares at $5.20. Your individual brokerage account will show fewer shares at a higher price, but the total value is the same. The problem is, the market sees this as a sign of weakness, and very often the newly propped up stock will just start to fall all over again. This compliance battle is the real context. Today's 3.22% drop isn't about the long-term potential of blue lasers, it's about the short-term mechanics of survival. This is where the difference in online investment platforms becomes so critical. When you're managing your retirement savings in Schwab Intelligent Portfolios or a diversified set of Fidelity mutual funds, you are intentionally shielded from this kind of single-stock binary risk event. Your Fidelity Wealth Management advisor would likely never, ever suggest a stock like BURU. But the game has changed. A platform like Robinhood, with its focus on Robinhood stock trading and easy-access Robinhood app, places a stock like this right next to NVIDIA stock. The SoFi platform, where you might have a loan or use the SoFi robo-advisor, also has its SoFi Active Investing portal, and BURU is just a few taps away. This accessibility is a double-edged sword. It allows self-investing in a way never before possible, but it also removes the traditional barriers that used to protect retail investors from highly speculative sub-dollar companies. Someone using Interactive Brokers, a platform known for its sophisticated tools, might be shorting this stock or trading options on it, understanding the complex risks. But on the simpler investing sites, it can look like a lottery ticket. The expectation is, I'm investing. The reality is, I am making a high-stakes bet on a company fighting delisting. Let's look at the financial reality, the numbers behind the 26-cent price. When you examine Nuburu's recent quarterly reports, you will not find the pristine balance sheets of Apple or the massive cash flows of NVIDIA. You will find the typical and very difficult financial profile of a pre-commercialization tech company. The primary number to watch is cash burn. This is the rate at which the company is spending its available funds on research and development, sales and marketing, and just general administrative costs. For companies like Nuburu, the revenue is often small, inconsistent, and lumpy, meaning it comes from a few small sales or development contracts rather than a steady stream of product sales. The 26-cent stock price is a direct reflection of this. The market is looking at the cash on hand, looking at the quarterly burn rate, and doing the math. The question is, how many months does this company have before it runs out of capital? When a company is in this position, it must raise more capital. But how? Selling bonds? Unlikely. That leaves selling more stock. But when your stock is at 26 cents, you have to issue an enormous number of new shares to raise any significant amount of capital, which heavily dilutes all the existing shareholders and puts even more downward pressure on the stock price. This is the microcap death spiral that investors fear, and it's a very potent reality in this part of the market. This is the primary risk that platforms like Fidelity, known for its long-term Fidelity IRAs and Fidelity ETFs, implicitly warns against by focusing on more established companies. So what does today's movement mean in this grand high-stakes context? A 3.22% drop is, as we said, noise. In a liquid, high-volume stock like Apple stock, a 3% move is significant and reflects a broad market sentiment. In BURU, it could be one large sell order from a single frustrated investor. The liquidity is paper-thin. If you decided to buy $50,000 worth of this stock right now, your order itself would likely cause the stock to spike, and you'd get a terrible average price. This is called slippage. It's what prevents large institutional funds, like those managed by Fidelity Investments, from ever touching a stock like this. They can't get in or out without moving the price themselves. This leaves the stock to be traded almost exclusively by retail speculators and a few high-risk hedge funds. This is a very different game. This isn't online investing. It's online investing's casino. The Robinhood cash management feature might give you interest on your uninvested-in capital, but that capital is at extreme risk when you deploy it into a stock like this, even more so than with Robinhood crypto trading. The whole thesis for Nuburu rests on a single binary question. Can they commercialize their blue laser technology before the capital runs out? Can they sign a truly massive, game-changing contract with a major automotive or battery manufacturer that validates the tech and, more importantly, provides a revenue stream that stops the cash burn? That's the bull case. It's the miracle scenario. I want to know what you think. Comment below, do you believe niche-specific technology like this is the future, or do you think larger, more diversified laser companies will just absorb this tech if it's proven viable? Let me know your take. Looking forward, there are 3 likely paths for Nuburu, and today's 26-cent price reflects the market's odds on each path. Path 1 is the miracle, the bull case we just described. A transformative contract is signed, the company secures its future, revenue pours in, profitability is achieved, and the stock price doesn't just go to $1, it goes to $10 or $20. Holders become rich. This is the 1% chance, the lottery ticket expectation. Path 2 is the grind, which is the most likely reality. The company continues to struggle, it executes a reverse stock split to regain Nasdaq compliance, it raises more capital through a dilutive offering. The technology works, but the adoption is slow and the company just limps along for years, its stock price slowly bleeding out, or it eventually gets delisted to the